Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 7th of November. Oil markets are trading a little bit sideways at the moment. It seems they're kind of stuck like a barnacle on a rock in and around the $85 mark, a little bit up, a little bit down from one day to the next. Even the China reports out this morning didn't seem to give it a direction. Let's go to Asia with Serena Wong, head of APAC analysis at Fortexa. Good morning, Serena. We saw that the news out of China this morning indicating that exports were looking, imports unexpectedly grew last month while exports contracted at a quicker pace. Does that tell us anything about China that we didn't already know? Your thoughts on the influence of China going forward on the oil markets?
Hey, good morning, Sean, and thank you for having me back again. Well, what we are seeing here in Fortexa is that China's crude imports have increased marginally on a month-on-month basis in October. But what's really interesting is that China's onshore crude inventories, after months and weeks of declining, have started to stabilize. And what we've been hearing is that a couple of refiners, including both state-run as well as the teapots, or what we call the independent refiners, have started to cut runs, and others are looking to consider to cut runs further this month. And I think it doesn't surprise us that this really indicates that there is some hint of bearishness on both the domestic demand as well as the exports point of view, and therefore refiners looking forward, probably gonna be cutting their runs compared to the previous months.
Well, let's stick with Asia and get welcome Yuri Humber, is the founder of the Japan Energy platform and CEO of the Yuri Group. Japan, of course, a major economy in Asia. It's very difficult to read its health at the moment. The yen obviously has had a crazy year, and yet inflation is growing there. It seems the prime minister, from being the most popular guy on the planet to now being the most unpopular guy on the planet. What is the outlook for Japan as a major economy, Asian demand going deep into the winter?
Thanks very much, Sean, and thanks for the question. Look, I think you mentioned some of the key factors there. Japan is one of the top 5 crude importers, the biggest LNG importer still. So it has a really important influence on the gas and oil markets. That said, Japan's has been hampered, if you like, by 2 factors. One is that the yen is now at we're talking a multi-decade low against the US dollar. So the purchasing power, if you like, of the Japanese consumers has been really hamstrung, and pretty much already for a good, I would say, a year it's been felt, but it's becoming more felt as the time goes on, partly because so far the government has been able to cover some of those increased spendings through subsidies, energy subsidies, and it's just announced an extension of several of the energy subsidies into early next year. But that isn't going to continue forever, and certainly can't be sustained on a budgetary level. So you're going to what the other factor that's been really changing sort of Japanese consumption, if you like, purchasing, has been this very strong push from the government for energy conservation. Now, we've had milder weather, and I think that's sort of true for a lot of other parts of the world. That's really taken the edge of both electricity demand and fuels demand. But beyond that, there's definitely been a really strong, noticeable shift in the fuel consumption. Crude imports, for example, this year out of Japan, they are, slightly better than in recent years, but this is still considerably lower than pre-COVID. Partly that again that's just sort of comes from a push by the government to tell people and businesses to conserve energy. And there's been, just to give you a figure, there's been a sort of a drop of power consumption in some of the sort of key regions around the country of 5 to 6%. Ever since pretty much February, March. So that's really a significant cut in both electricity use and therefore demand for fuels. How that will go in this winter? Well, for one, Tokyo, November, and we have 26 degrees outside Celsius. That's a little balmy.
It's a bit like Dubai then.
Well, maybe not quite that level, but it's certainly unexpected. That's for
Dubai is
sure.
28 today, so.
Oh, really? Wow. So yeah, there you go. I mean, it's generally we have a slightly milder autumn than most people think, but still, if you're an oil, well, especially if you're an LNG buyer, how do you guess how much fuel you'll need, precisely? Therefore, the volatility, in for example, the JKM, the volatility recently has been really, really high. Some days, a broker was saying they'll come in and the price is down 3% in the morning. And very few traders can say why that is. And I think it's just because of that, not just the weather uncertainty, but, the conservation uncertainty. How long can conservation measures have a really strong impact on business consumption and household consumption?
Right. Let's go to the supply side. Paul Hicken, editor-in-chief of Petroleum Economist. Paul, we had the Saudi Aramco announce yesterday that their official selling price for the coming month, for the first time in many months, they've kept their Arab light grade, the sort of sweetest of them all, to Asia unchanged, with premium $4 over Oman, Dubai. What does that tell us? Maybe it's some of the signs we're seeing there. Asians' demand is weak, and Saudi needs to hold the line. Your thoughts on the Saudi action, to extend their cuts through the end of the fourth quarter, and now holding OSPs flat?
Yeah, thanks, Sean. I don't think it was too unexpected that Saudi was going to do this, and I don't think it's unexpected that you could see prices at some point plateau because at the same demand isn't that strong. I think we've had the geopolitical risk premium, and we're back to where we were, also start of October, where that bearishness had already kicked in, and the geopolitical risk premium from the atrocities in Gaza. We're back now with that risk premium off the market, where people aren't really sure about making the jump from what is happening in Gaza to a wider region. So the market's not really calculating that now. It can easily be put back on and off, obviously, that risk premium, but now we're back to looking at fundamentals, and we were back in early October already talking about a slight bearishness in the market, $80 to $90 barrel range. That was where we were at, so it's kind of masked. We were already in that sort of bearish trend, and I think OPEC has been very well aware of that. I mean, that's why they're extending their cuts through to the end of the year, and the likelihood is they're probably going to extend it further. I think $80 a barrel, 75, 80 seems to be the OPEC floor that they're prepared to defend. And I think, we're nowhere out the woods in terms of global demand, uncertainty, and certainly some weakness as well. Markets, no real clarity in the market, and OPEC won't want to take any chances. It wants to be in control. It wants to be in the driving seat. And I think that's why you're going to see probably extension of the cut. But what's interesting is this 1 million barrel a day voluntary cut, how much they cement that into actual plans, because this was supposed to be just an extra bonus. Do they really have the stomach for, they're hunkering down for a long term, extra production cuts and taking more of that? And that's certainly an interesting dynamic for OPEC going forward.
Well, it's certainly expensive to keep 1 million barrels shut in, particularly when it is now moving from a short-term decision to now bedded in, as you say, as well as another 2 million barrels of idle capacity. They're now carrying 3 million in total, significant amounts. Serena, your thoughts on the global oil demand indicators? We're seeing on the shipping side, AP Moller Maersk announcing they're laying off 10% of their staff. The supply chain index is indicating, relatively untroubled, the lowest trouble for supply chain for many years. What are your indicators on the oil demand looking forward now, ultimately into 24, as contracts trading now into the new year?
Yeah, I mean, I think you can actually slice and dice global oil demand kind of analysis and outlook according to geography as well as across the various products. But overall, I think there, like what Paul mentioned, there is kind of like a very more bearish sentiment, just simply because if you look at across the globe, The PMIs of the major economies, the US, Europe, and even China, all of them in the past couple of months have suggested a contraction overall in their economies. But the reason why I say that there is some difference is because across the various products, for example, you see that naphtha, gasoline, perhaps, are not doing particularly well, including fuel. As we all know that petrochemical margins have been languishing. Your PDH plants, your crackers in China as well as South Korea are really struggling to survive. So from that perspective, demand doesn't look good at all. But from a seasonal perspective, diesel has really gained strength and still remaining. Cracks have remained pretty strong. And I think that at the end of the day, if you look at diesel, it's going to be the lifeblood of the economy. Even if inflation figures remains high, government subsidies will kick in to really support industries and also from that perspective, even from a seasonal perspective, as we all know, gas oil strength in Germany for winter heating, it's looking pretty robust. So from that perspective, diesel would probably be the front runner in terms of demand in this quarter.
Yuri, just picking up again on the Japanese monetary policy this year, basically not doing much to defend the yen out to 150 at a time when the oil prices are averaging, year to date, $85 or so. How are the Japanese consumers absorbing that increase in cost, given the weaker yen buying dollar-denominated commodities and not, seeing demand destruction of any significant level? Your thoughts going forward, does it eventually translate in 24 to Japan demand destruction?
Well, your question is how are the Japanese consumers feeling about this? The answer is not very well. Look, I think I was in the UK not this summer, last summer, for a couple of weeks, and I don't remember a day going by without the TV or the radio not discussing the cost of living crisis, from morning till night. And that didn't really affect Japan at that time, but I feel like this similar sentiment is starting to kick into Japan. One, as you mentioned with the weak yen, when the yen wasn't such an issue, certainly to this extent, some of the inflationary commodity inflationary issues were able to be absorbed to a certain extent, and you still had the government subsidies to, if you like, to put a certain buffer. Japanese utilities are not allowed to pass on fuel increase prices straight to the consumers. There's really a 4 to 6 month delay. So that also takes a while. But now these pressures have really come through. And you can, as you mentioned, Prime Minister Kishida's ratings are now below the 30% approval rate, which tends to be, once you're in the 20s, it's not absolutely the end, but it's certainly extremely risky for a Japanese prime minister, because, as we know, there's been quite a lot of prime ministers that have left within the 2-year time frame due to falling popularity. So he's trying to put out his just announced a really large additional sort of economic stimulus package. But the popularity, if you like, that hasn't really come through to the consumers in a very favorable manner. One of the reasons is, because people are looking at the cost of sort of the cost of goods, groceries, all of which are driven by energy prices. And these energy prices are now, really starting to be felt much more stronger. So just to give you a sort of a strange anecdote, the government's offering to give some cash handouts, if you like, especially to the lower income households. And that's seen as a negative thing by most of the voters, because they believe that, ultimately that money is only going to go into a bank account, isn't going to stimulate the consumption further. And therefore, we're really in a bit of a challenging situation, especially as some of the monetary developments by the Bank of Japan suggest that we may start to get into a slightly higher, or if you like, at least not negative interest rate environment in Japan, which again increases the cost of financing loans and purchasing, of course.
Paul, the geopolitical risk premium, as with the sort of known in the oil market, as you said earlier, has seemed to has after initial elevation on the back of the tragedies in Palestine, there's come off now. Is that the market asleep or alert to the risks here, do you think? I mean, with Ukraine also now moving into the winter, where is that geopolitical risk factor, do you think, and could it surge back?
Well, I think if you look back at what happened with the Russia-Ukraine crisis at the time, the market's taken some lessons from that. If you think prices went up to $130 a barrel on an actual huge producer of crude, a supplier of crude to the market, and that the shortages there never materialized. The supplier outages have never materialized, even with sanctions, haven't materialized.
I was just reading yesterday a report on the amount of gas that's still passing through Ukraine to Europe. I mean, this is all smoke and mirrors, really.
Exactly. So when the market started to price in that risk premium and prices went through the roof, it just didn't materialize because, the market finds a way. No one's the supplies and demand. No one really wants to cut off energy. It's a really big deal. Yes, there's been, even with we had Albuquerque in 2019. I think there was ways to quickly find it back on. Saudis, that was probably a much bigger risk. But here at the moment with the Gaza situation, you've got to make so many leaps before you actually get real supply disruptions. I mean, even if you look within Israel and Palestine itself, it's the Leviathan field, the gas from a gas perspective. Some of those fields are still operating, they're still okay. So even there, you probably start to think about look at the gas situation there. I know the Tamar field has had its issues, but you'd have to look broader in actually the gas issue before the market really starts to calculate what the impact for oil for Iran or the Strait of Hormuz or however you sort of look at that. And it's a lot of leaps to make. So, and like I said earlier, that you can put a risk premium back on quite quickly. And I think, the market probably got a little bit ahead of itself, even with that $5-10 risk premium. It's been working its way off, and looking back at probably the fact that the issue is that demand fundamentals are still really driving the market. And now the conversations today, we're not really talking about risk premiums as much. The sort of top stories of the day are all sort of supply and demand driven now. So we're back looking at those factors. So I think the market is where it needs to be in terms of where the risk premium is. Really, I think we're still way away.
It's also happening, isn't it, at a time when, as we've just been articulating, there is sort of neutral to weakness on the demand side, and there, as the case with the Saudis now, if you like, that Saudi cut is now could be moving into a bearish framework, in the sense that it's kind of a no longer a cut, it's sort of now spare supply. So the idea that there's lots of spare supply around, and the sort of narrative on it moves from being a tightness factor to being a bearish factor. Your thoughts on that, Paul?
Yeah, exactly. I mean, this is where OPEC wanted to be. That's why I mentioned it, them being back in control. They've got 4 million barrels a day of spare capacity, rather than what historically it's been more like 2 million barrels a day, and anything below that starts getting very tight in terms of what power OPEC has. We saw it back in the earlier this year with the banking crisis wobbles. Whatever it did to cut prices back, cut supply then to try and support prices, it was really struggling at that point to keep prices above $70 a barrel. And the Saudis got quite irritated by this sort of just disconnect between supply, physical markets, and futures market, where it seemed to got amplified. But now that irritation's gone, and it feels like even I know Yuri said that there's the risk from Asia in terms of inflation and demand destruction, but at the same time, it's been fairly quiet in terms of there seems to be a begrudging acceptance from consuming countries, the US, India, and others. There seems to be a begrudging acceptance that 80 to 90 is probably a new dynamic in the market, a new normal. Feels weird to be this high. I feel like Bob Dudley, higher for longer. But that seems to be the seems to be somewhere where we're at, and I think there's an acceptance that's going to be a longer term situation.
Let's go to the survey question, looking at the original question this morning. China's imports unexpectedly grew in October, while exports contracted at a quicker pace. I'm just wondering to myself, when I saw the headlines today, is the worst over for China's post-COVID economic recovery? I mean, ultimately, the worst of what has, if this is indeed, one can use the words worse and bad, that the Asian, the Chinese economy coming out of COVID, we were expecting the year of two halves. Everything would be a big bounce in the second half of 2023. It's never really happened, that narrative. But is the worst over at least? And moving into 24, perhaps we start to see things ticking up in China. Yes or no? Your thoughts on that? I wanted to get your views, Serena, on this sort of quiet, but I think somewhat significant story in the background, the drought at the Panama Canal causing a reduction in the amount of traffic that, and they now have a plan that over the next this 6 months through to February, they're going to halve the number of vessels that can go through the Panama Canal on a daily basis. That seems somewhat dramatic to me. Your thoughts on the impact that has for world trade, for oil flows, etc.?
Yeah, I mean, well, this is going to be a game changer. It's going to reshuffle pretty much quite a lot of trade flows now, simply because with the drought restrictions, the number of, Panama Canal transits is going to fall drastically, like what you mentioned. And just based on Vortexa statistics, we are seeing over the last 12 months, at least 2.5 million barrels per day of liquid bulks passing through the Panama Canal, and that's before the restrictions, and another 10 to 11 million tons per annum of LNG cargoes moving through the canal. And what this means is that if we reduce the number of transits allowed, especially with oil tankers being deprioritized over other vessel classes like your containers as well as your natural gas carriers, it's going to lead to a rerouting of critical oil supply coming from the US Gulf to East Asia, and also to a certain extent to South America, West Coast. And what this means is longer distances, longer voyage time, and inevitably higher freight costs, just simply because of the longer distances. And overall, it's going to also increase tunnel demand utilization, and it's just going to lift all the shipping freight costs. And eventually, I was just talking to Yuri earlier, all these costs will be passed on to consumers, and that will inevitably lead to more inflation at a time when we're trying to control inflation as much as possible.
Yuri, just picking up on that, the integration, we've talked obviously the Japan story, but the integration of the Asian economic story, if China exports contracted at a quicker pace in October, ultimately that's less imports from around the region, commodities from Australia, etc. I'm wondering what China's sort of malaise means for the major economies of Asia, Japan, South Korea, etc., all big export-oriented countries.
Thank you. So I'm not a sort of a China economy specialist, so I wouldn't I would hesitate to make a call whether the worst is over or not. But I would say there are issues that we should think about in the China economic story. And we know about the US-China tensions and how they've been simmering for a while. That's sort of the geopolitical story. But I look at it in a more sort of energy industrial sort of lens. And with that perspective in mind, you see that Japanese companies, first of all, Japan is reviving the semiconductor industry, right, in a strong way with massive support from the US. One thing we know about the semiconductor industry is you need a lot of energy. And that the demand that maybe sort of US would have placed with China is now going to go to Japan. Again, this is all happening fairly quickly. And even if the plans don't materialize quite as envisioned, we're still talking about sort of this decade, the latter half of this decade. So similarly, other sectors are starting to maybe, if not entirely move out of China, then to minimize production. Mitsubishi Motors recently pulled out of China. Some of these moves are competition related, just because Chinese companies are getting stronger, more competitive. Some of them are clearly geopolitically constrained. You know, China recently arrested one of the top executives of a Japanese pharmaceutical company, claiming that he was basically spying, industrial espionage, something the company denies, something that, you know, the Japanese government denies. But either way, China is adamant that that's the case and has now, charged them and imprisoned them. So what that tells Japanese companies is we should be extremely careful about sort of making further investments and further expansion in China. Then sort of, if you like, that's going to be mirrored a little bit more across Asia, maybe Southeast Asia, Europe and US, in terms of the China investment. So I think there is a rebalancing in terms of sort of the relationship with the Chinese economy that we've had up to now. And that rebalancing is going to take a little bit of time. It's not going to be a very straightforward sort of up and down 1 month.
Well, it's certainly that bigger narrative, isn't it? The China decoupling, the supply chain decoupling over 10 years to come, coming out of COVID, a decade which obviously many other countries in the region may benefit from, India in particular. Paul, let's survey result to you, and also I wanted to get your views. China's imports is this the lowest? No, it seems this room thinks that China still has some low to go. I wanted to get your thoughts, Paul, on where we started. Your earlier comments. Will Saudi Arabia continue its voluntary supply cuts through to the first quarter? They've told us they're going to do it to the end of 23, and now it's all about 24. And we have a report at Bloomberg today that there's a record number of super tankers heading to the US to pick up oil over the next 3 months. 48 vessels are expected to take oil from America to the world over the next few months. This is on record U.S. oil production, more and more U.S. oil available for the global market. This is kind of then maybe starts to feel a bit deja vu like, with shale boom a number of years ago, crash in the oil price as OPEC cut to prop up prices. I mean, you wonder how long does OPEC and particularly Saudi stand on the sidelines and create a party for everybody else while they're recording budget deficits?
Well, I mean, it seems a bit extreme because, I mean, Saudi's still creating $80 plus for their fiscal budgets, and it's a line in the sand for Saudi, so they clearly want it. And you're never really sure what the counterfactual would be if they didn't act, where price would be. So it still could be a party for Saudi Arabia at $80 plus. And I mean, you've got a few factors going into next year, haven't you? I mean, election cycles, India, US, others, all big consumers. So there's going to be that factor that plays into the consideration at the same time as those potential Saudi cuts being extended. So it is a complex situation. And then you've got to think about crude quality as well, which is, remember, like, Saudis have taken a lot of heavier sour grades out of the market, and the US are still need, regardless of what US talk about energy independence, they still need the heavier sour grades, which they often get from Canada and even would potentially get from Venezuela as well. So that's that into the mix of a reordering of flows. So that's something else to keep in mind into 2024.
Well, we're going to have to wrap it up there with Brent crude oil trading in this morning in Asia, as we said, down about over 1%, closer to $84 a barrel, 84.22 on Brent this morning. So it seems to me when all things are neutral, there's a downward draft in this oil market. Yes, yesterday Saudi says they're going to extend till the end of the year. We kind of knew that. I thought that was already announced. Actually, maybe I'd missed it. It was just November. But ultimately, there's a downward momentum here, and I think going into the new year might need continuous propping up, and maybe that will be the bazooka for the $85 oil in the first quarter. The announcement that Saudi will indeed extend this cut through to Q1. I wonder will they keep it on a month to month? I think they get more out of their dollar if they bang it for 3/4 or for 1/4, but we will have to see. Paul Hicken, as always, amazing to have your insights, petroleum intelligence. Yuri Humber, great to have you at the table, and Serena Wong at Vortexa in Asia, really great to get all of your insights. Look forward to catching up with you again soon. All the best. Have a good day.
Thanks, Sean. Thanks all.
Cheers, guys.